Hello, and welcome to the FATCA discussion, clarification of the forms. My name is Lawrence Kiddle, Director of FATCA at Thomson Reuters, and I'll be your host for this session. And thank you for joining us for this FATCA webinar. As well as the discussion, we'll actually ask 4 multiple choice questions on your current forms process, and we'll display the results as we go through. And they're to give some insight into what your peers are currently doing and planning around the FATCA forms, as well as the more formal part of the presentation. So you'll see 2 multiple choice questions on the right-hand side of the screen, and then 2 later on in the presentation. So if you just please select your appropriate answers, and then, as I say, we'll display results as we go through to give you a bit of further insight. Now, as you all found out, FATCA likes to keep us on our toes, and that's a message reinforced by the recent announcement of the delays to the onboarding processes. And this had the effect of pushing back many other key FATCA-related dates. Our focus today is on the forms, and primarily on the W-series forms, W8s and W9s. So we first saw drafts of the W8 Ben E last summer, and ever since then there's been debate as to when we may expect the final forms and instructions, and on the impact these will have on your current business processes. There's also been considerable confusion following the publication of the first set of intergovernmental agreements as to what will actually constitute adequate self-certification. Now, we can't promise to resolve the uncertainty in this discussion today, but we do hope to provide some clarity around the timelines, both published and expected, and on how businesses can move forward in their FATCA onboarding projects in a framework that permits further change as these timelines evolve. Our key speaker today is Danielle Nadisha, Director at KPMG. Danielle advises financial institutions and other withholding agents on their tax withholding and information reporting requirements for payments made to US and non-US account holders and counterparties. She's a Director at the International Corporate Tax Group of KPMG's Washington National Practice. Danielle joined KPMG in April 2013 and works out of the firm's New York office, practicing in information reporting. And prior to joining KPMG, Danielle was an attorney in the Office of the Chief Counsel International at the Internal Revenue Service from April 2009 to April 2013. And at the IRS, she practiced in income tax withholding and Subpart F, and was principal draftsperson of the FATCA regulations, the pending proposed Chapter 3 and 61 conforming regulations, and other published guidance under sections 1441, 1442, 1471 through 1474, and 6050W. Many of you will know Danielle. She's a frequent speaker both in the United States and internationally regarding FATCA and other reporting issues. And prior to joining the IRS, Danielle was an attorney with Burt Staples and Main LLP. She's a graduate of Georgetown University, Southwest Law School, and the University of California at Santa Barbara. So, over to you, Danielle.
Hello, everyone. I will start this off by saying when we started this webcast, we had, of course, anticipated that we would have brand new forms to discuss. That didn't work out. But what we do have is a notice, 2013-43, which is basically the FATCA delay notice. And this is obviously a welcome notice in the industry. What it did is push FATCA back 6 months. That's not a huge amount of time, and what that 6 months really did was give the government more time to get the guidance they needed. Really, if they were going to start on 1/1/14, they should have had all of their guidance issued on June 30th. You know, all of the forms, the FATCA agreements, the 1042S, and the U.S. account reporting forms, all of that should have been done around June 30th, and obviously they're a little behind schedule. So the 6 months notice is really designed to allow them to catch up with the guidance they need to do. And now we'll have a start date of FATCA of July 1st, 2014. And it's basically a wholesale pushback of 6 months. So registration will start this month in a few weeks, hopefully, but it's not required until April 25th. 2014. I would say don't wait until that date. You may have obviously issues with the registration process, so you should at least start registering at least a month in advance of that date. Withholding won't start until July 1st, 2014. Your new account onboarding requirements don't start until July 1st, 2014, and the grandfathering date has been extended until July 1st, 2014. The other thing they've done is push back the expiration date of the QI, WP, and WT agreements until that date so that they can get those agreements updated and that people aren't renewing under the old agreement and then having to redo their agreements for FATCA. And finally, one of the biggest things they've done, and that's relevant to our seminar here, is they've extended the expiration dates on the Forms W-8. This is actually a big deal because many financial institutions were just about to do the recertifications, and we're sending out the old forms sometime this month. And what we're hearing from most of them is that they're going to hold off on that. Unless you have some reason that you weren't compliant with Chapter 3 and you need to get your forms out for Chapter 3 purposes, if you were compliant with Chapter 3 and your forms were set to expire and you were doing your recertification around August or September, most of the institutions are going to wait because hopefully the new forms are expected out within the next few months. And so the hope is that they'll be able to do the recertification sometime next year, maybe around March, and actually use the new FATCA forms. And we'll get into that a little more later. The other big points with Notice 2013-43 was that it pushed back the due diligence by 6 months, so you won't have to document prima facie FFIs until the end of 2014, and you'll have an extra 6 months on documenting your high-value accounts and all of your other pre-existing accounts. Another major point of the notice was that it pushed back the reporting date. The reporting was only required on March 2015 to start with, but previously that requirement was on March 2015 you would be reporting for year-end U.S. accounts on 2013 and 2014. And because of the pushback, they basically eliminated the requirement to report with respect to the 2013 year. So that has been a big relief for the industry. So those are the key points with 2013-43, and because of that, obviously, the guidance has been delayed slightly. The government wasn't ready with all of the new forms and with the portal opening, and so we're expected to see our guidance trickling out within the next few months. And so when are we expecting this new guidance? Well, as we indicated before, the portal is opening on supposedly August 19th, 2013. That's in a couple of weeks. Prior to that date, they're going to need to release the Form 8957, which is the final registration form, and all of the instructions. They'll also need to have released the FFI agreements, otherwise FFIs won't have anything to sign. And so we are basically expecting that any day now. That is pretty much going to tie the government up for the month of August. After that, from what we've heard informally, they're prioritizing the draft 8966, which is a U.S. account reporting form. That's important because no one's seen a draft of exactly what's expected to be reported, and the final versions of the 1042 and 1042S. We are looking for those somewhere around the end of August through September. The next priority then is the withholding certificates. We're expecting, starting in about September, the W-8 IMY draft to be completed, and the final forms to start trickling out between September and the end of 2013. And we would also look for the W-9 to be finalized soon. Some of the questions about why we haven't seen a draft for a new draft, I should say, for the W-8 IMY when we've seen a draft for all of the other forms. I think one of the reasons for this is simply, it's not the FATCA statuses, it's not the basic structure of the IMY. I think that's at issue, but the IMY does address some Chapter 61 issues. For those of you who are tuning in from outside of the country, it addresses some domestic reporting issues that were ducked in the initial draft, but for the final draft will have to be addressed. For example, if you're a QI, are you ever passing up the reporting of a U.S. account for 1099 reporting? Is that even going to be necessary in a post-FATCA world? So I think that's probably one of the reasons that we haven't seen that form yet, because it implicates other issues that they're working out through the harmonization regs. And while I didn't include information about that in these slides, because this is really a form slide, I will point out that we are also expecting reg guidance to be coming out in the next 3 to 4 months. We are hopefully expecting to see a draft of the harmonization regs, which is Chapter 3 and Chapter 61, by the end of the year. The government's indicated, and has been for a while, working on a set of technical corrections. It's been in progress, I think, for at least 4 to 5 months. And so that is actually expected any day now, but it's been expected any day for about 4 to 5 months. So we just have to wait and see with that. The government has also indicated that they may do another set of discrete substantive changes to the regulations just to clear up things that are not necessarily technical corrections. And it's not expected to be a broad, wholesale change to the regs. It's just targeting specific issues where they feel it's really necessary to make those substantive corrections before FATCA goes live. And so all of that we're hoping to see before the end of this year. And so moving on, some of these questions we have received previously from listeners. And one of the questions we received is, when do we start using the new Forms W8? When do we have to start using them? When should we start using them? And can we use them now? The easy answer is you're required to start using them within 6 months of the release of the final forms. Since we're expecting final forms sometime between September and the end of this year, that would line up with being required to use them sometime between March of 2014 and the start date of FATCA at the end of June 2014. Can you use the new forms now? Yes and no. You can't use a new form until it's released in a final form. So the simple answer is no, but there are ways that you could use certain of the forms. And I think the key one is the Form W8 Ben for individuals. You're perfectly fine to continue using the old form at this date, but if you wanted to start collecting a new form that would hopefully work once those forms are finalized, what you cannot do until a final form is issued is start removing things from the form. So, an example of this is on the W8 Ben E, how the capacity line was removed and replaced with a checkbox. You're not allowed to do that on your substitute forms until that form is finalized. And so you can't take away anything from the current version of the form. But you are allowed to add to the new version of the form if you want to. And so if we look at the W8 Ben individual, there really haven't been a lot of changes. People using their substitute forms have always created a W8 Ben individual, even though it wasn't technically a form, where they've stripped out all the entity classifications. And so you can continue to do that. If you want to amend it for the new form, you're basically adding just a couple of fields, primarily that foreign TIN required field and the date of birth field in case that foreign TIN isn't there. Like I said, if this isn't a requirement, you can definitely wait until the new forms are out to do this. The one reason that it may be beneficial to start collecting this now is that we know it's coming that you're going to start having to report foreign TINs of individuals or entities to the extent they're provided. And it's going to be a requirement of the form, where it's expected to be a requirement of the form that you either have a foreign TIN or if your country doesn't issue one, you provide a date of birth if you're an individual. What we don't know, we haven't seen in guidance, is whether the government's going to make you go back retroactively and look for any TINs you have in your file. And it could happen, a couple of ways. They could say, look, we're just going to do this on a prospective basis. When your new forms come in, you take those TINs and you record them. It would be the easiest result for the industry. However, seeing what's being done for FATCA purposes, if you look at the requirements imposed upon foreign financial institutions with respect to their U.S. TINs and their Forms W-9, the government wasn't requiring that on a prospective basis. They were actually saying, look, if you have a TIN in your file, you go and find it. And so it would be consistent with that approach if they were to say also to the U.S. withholding agents, you have to look through your old files and find out if you have a foreign TIN. And obviously that's problematic to U.S. withholding agents because even though this field was always on the W-8, since it wasn't required to be reported, most U.S. withholding agents weren't recording that information in their electronic files. And so this could potentially mean a manual search through all of your records. We don't know if that's going to happen now, and so it's not something worth getting worried about. However, it's obviously to your benefit that if you start using the new forms where the TINs are required and you're going to be validating those forms anyways, it's a lot easier to get those forms as they're coming in and start inputting them into your system than it is to go searching through files for copies, for any instance where they provided you a foreign TIN. And so that might be a benefit. I'm not necessarily recommending that because we don't know what the requirements are going to be with respect to the foreign TIN yet, but that might be an advantage of starting to use the new form currently. One thing I also want to address, because we have a lot of questions coming in, And a few of you have asked this, whether you are the only participant on the line. You are not. There are at least 400 of you. It only appears like you're the only participant because that's all you see in your view. But we do see all of you, and we do see your comments and questions. Okay, so moving on, off of the Form W8BEN individual. This isn't in the slides, but I will point out that there is also another substitute form that was created in the FATCA regulations, the non-IRS form for individuals. And what that form is supposed to do is permit institutions who are complying not just with FATCA, the U.S. version of FATCA, but who may also have to comply with FATCA laws imposed by other countries with respect to exchanging information. So, for example, if you're in the UK, you might be collecting information for U.S. purposes, but you also might have an exchange agreement with Italy where you might have to collect information on Italian residents. And so rather than using a different form or always using a U.S. tax form, which may not seem practical when you're in a foreign country, this non-IRS form was supposed to replicate the information necessary on the Form W8BEN for individuals, but make it generic so that you're not actually giving your clients a U.S. tax form. This form, because it's written in final regulations, it doesn't actually hinge on a new W8BEN being released. And so you can actually start using this form now. If you're basically following the regulations, creating your own version of the form. It's slightly different than the BEN. It's not asking for country of citizenship, obviously, because that's kind of a U.S.-centric term. Instead of that, it's asking for the person's place of birth. Obviously, the idea there was to try to capture as many U.S. citizens as possible using generic terms, and the person's residence. They're required to include all of their countries of residence, so if they have more than one, they would hopefully be capturing dual citizens this way. That is a form you can start using now with a caveat. It's probably more helpful for foreign financial institutions to start using this form in cases where the client hasn't invested in U.S. securities or any other U.S. source income. The reason is Chapter 3 has not incorporated this concept yet because we don't have the harmonization regs released yet. Nothing permits you to use this non-IRS form for Chapter 3 purposes. Obviously, we expect that that'll be coming, and there may be limits on it. You know, for example, it doesn't currently provide a treaty claim on that non-IRS form, so it may not be practical in all cases for Chapter 3. But we would expect it to be utilized somewhat in Chapter 3 cases, but that hasn't been permitted yet. And so while you can create this non-IRS form, you have to make sure that you are only using it for FATCA purposes and not for Chapter 3 purposes. But if you have clients who aren't receiving U.S. source income, that obviously can be beneficial, and you can start using that now. For all other forms, in particular the W8BEN-E for entities, the IMY, you really can't start using the new form because these forms are so complicated and they change substantially what the old form looked like. And we're expecting changes. I mean, when we're looking at a 7-8 page form, there are going to be some changes that should be expected when it's finalized. And there actually are a few changes that we are definitely expecting because there obviously are going to be some errors in the draft form. The result is if you create a new form, you're going to end up having to change it. And so you really shouldn't be using those new forms yet. But what I will say is you're going to start, once the final regs have been issued, you're going to want to start using those new forms as soon as possible. The reason for this is you can't start documenting your Chapter 4 status of your customers until you start using that new form or a substitute of that new form or a written statement based on that new form. And so if you document someone under the old form, you're just going to have to come back within a year or two and get them to fill out the new form again. And so it really is to your benefit to start using that form as soon as possible. The other reason is if you've delayed your recertification process based on Notice 2013-43, you're going to want to start sending out your new mailings by March of 2014 because those old forms are going to expire. Because you want to start using as soon as possible, you're going to want to start making changes. If you're using substitute forms or electronic forms or doing written statements, you'll want to start that process as soon as possible. And what we're hearing from many in the industry, because it's a very complicated form and because there are so many changes, what they're doing right now is sort of prepping a substitute form that they're not putting into use, but that they have sitting and waiting until the forms are finalized, so that when the forms are finalized, obviously there's not expected to be a complete shift. The two drafts we've seen thus far look pretty similar. There might be some minor wording changes. There might be a couple of, substantial changes to the form, but the idea is if you've already got a draft already mocked up, you're not starting at zero. That you'll take the new form, you'll look for the changes, you'll modify it, and you'll be further along in your process. And especially if you're using an electronic system to collect your forms, that takes programming, and so it may be helpful if you start thinking about that now, even though you don't have the final forms yet. The other benefit of using the forms as soon as they're released is that the new forms will, in some cases, provide you indefinite validity for certain Chapter 4 statuses. That can be a huge benefit, especially if they were receiving U.S. source income and you were consistently, renewing those forms. If you're allowed not to do that in certain cases, and one of those statuses is an active NEFI, that you're going to have a lot of clients that fall into that category. So it may be to your benefit to just get the new form, validate it once. You're going to have to check for changes of circumstances, of course, but then you'll never have to do it again, hopefully. And so that may be a benefit of using the new form as soon as possible. Okay, and so we don't have final forms, but we can talk briefly about, what substantial changes we've seen in the drafts thus far, and whether there's anything we're expecting to see coming up. Most of you, because they've been out for a year, will be familiar with most of this. Obviously, the new forms have introduced that floor and tin requirement. They've introduced the new FATCA statuses and all of the associated certifications. There's a new disregarded entity line and a new Part 2 of the W-8 BEN-E, and we're expecting to see it on the W-8 IMY, which we'll go into in 1 second. And then we've seen the capacity line replaced with a checkbox, which should make things somewhat easier. The certifications have also changed slightly. Regarding that new Part 2, that is supposed to accommodate the fact that, for example, if you are a financial institution organized in the UK, but it's actually a branch in Germany that's receiving the payment, you may need information on both your UK location and your German location. You'll need the UK information for treaty purposes, and so everything that relates to the treaty claim has to relate back to the headquarters of that entity. In the meantime, for FATCA purposes, because every branch in another country is essentially treated like a different type of entity, where it has its own GIN, it's going to have its own country match and its own sort of indicia that you're looking for, it's going to be necessary that the form accommodate both of those things. This actually should be, while it complicates the form somewhat, it should make things slightly easier in terms of not failing as many forms. Under the prior version of the form, the requirement was if they put a GIN on that form and you see any address outside of that GIN country, you're going to have to fail the form, and it appears to be an incurable error. There isn't a way to say, oh, well, I just wanted to route this through this country for this, for some reasonable cause. There isn't really anything in the regs that lets you correct that. And so the benefit of having the two addresses on the form is we expect that the government's going to say, okay, that's okay. We understand that you have a headquarters in one country and you need to put that headquarter information for treaty purposes, but it now allows you to also put the branch that's receiving the payment. And as long as both of those countries, there's a good GIN for each of those countries, that should be fine, and it should cure some of the forms, or prevent some of the forms from failing. Obviously, if there's a third random address on the form, that could still be a problem under the regs. But that is the biggest change we've actually seen in the latest draft of forms. The other thing I will point out is the EXP. While this form doesn't get a lot of attention, the changes done in the EXP actually reflect that form got substantially more complicated. I think when I was back at the government and we did the initial draft, there was an expectation that, look, if you're a government, you're a government for Chapter 3 and Chapter 4 purposes. If you're a central bank, that's what you are. You're just a central bank. And so you could just check that box and you'd be done. However, the changes to the final regulations of the FATCA regs highlighted that there actually will be differences. There will be cases where you qualify as a central bank for Chapter 3 but not for Chapter 4. or you'll be treated as an international organization for Chapter 3, but not Chapter 4. And so the form now requires two different classifications. You're identifying yourself as an exempt entity for purposes of Chapter 3, and then you're going to need to go in and identify whether you meet that qualification under Chapter 4. The other departure this new version of the form has made from the others is that previously the rule was, I will continue to fill out whatever form I would have done for Chapter 3. And all of the coordinating Chapter 4 statuses will be there. And so I just keep using the same form I always did. That rule changes with the EXP. The way the EXP is drafted now, you're only going to be using that EXP if you are exempt under both Chapters 3 and 4. And so if you're exempt under Chapter 4, but you'll be withheld upon under Chapter 3, you always would have been using likely the Form W-8-BEN because you wouldn't have qualified to use the EXP in the first place. But the opposite will also happen. And so even if you would have been exempt for Chapter 3, if you're going to be withheld upon for Chapter 4, the government's saying, look, the purpose of the EXP is that these people are exempt from tax. And so if you're not exempt and you're going to be captured by one chapter, they're going to send you back to the W-8-BEN-E to fill that out instead. And so that is a subtle change in the rules. But basically, everyone filling out the EXP will be exempt for 3 and 4. If you're not, you're going to default back to the W-8-BEN or the BEN-E. The final thing I want to address about the form changes is we've gotten actually from our clients a lot of questions regarding the Form W-9. And the only major change that happened to that form is with respect to exempt recipients. There's now 2 boxes for exempt recipients. The person will identify whether they're exempt for domestic reporting purposes and whether they're exempt under FATCA. Most institutions will not need to pay attention to both boxes. If you're a foreign financial institution and you're not doing anything for domestic reporting, you're really going to focus on those Chapter 4 statuses. I should say there does not appear to be any reason for you to ever code into your system all of those various specific classifications. And so on that form, it's not a checkbox anymore where someone's just going to come in and say, I'm exempt, that's it. They're going to have to go through the list and actually specify why they're exempt for Chapter 4 purposes. The purpose of that was really because that exempt box had become almost unusable in the industry. This wasn't a FATCA issue. It was just that previously there were a lot of people who just liked checking the box and saying they're exempt while not really knowing what that means. Even though there were instructions, we know that they often don't read the instructions. And as a result of that, a lot of withholding agents were taking the position that I know that everybody just checks this box, and for that reason I can't rely on it. And that defeats the purpose of having the box. And so to cure that issue, we created the coding where they would have to actually tell you why they're exempt. So you know they've read them, you know they've decided, yes, I'm a corporation, I meet this exemption, and they're specifying why it is. And so if you are calling into question whether they're exempt, you know at least why they're claiming that status. And the idea was that we would be more reliable than the simple checkbox, and that withholding agents then would be able to rely on it. But the only purpose of those codes under both Chapters 61 and under Chapter 4 was to create a way whereby the person filling out the form could communicate to the withholding agent why they're exempt. It was never intended that that information needed to be transferred back to the IRS, which means you really shouldn't need to save it in your system. You can, but obviously if they're telling you they're exempt, they're not going to be reporting this information. The point of that is to say, I'm not subject to reporting. You don't need to report to the IRS. If you're not reporting to the IRS, there isn't really a place for you to put that code anywhere because you're not sending anything with respect to this person who's filling out the form. And so for FATCA purposes, you're going to need to indicate whether they're a specified U.S. person or not. But we haven't seen any reason for you to actually have to log in all of the various codes that they might fill in. It really could just be simple as specified person, non-U.S. specified person. With respect to the Chapter 61 codes, that answer is still the same. It wasn't intended to be reported to the government. It may not need to be recorded in your system. The reason you may want to is obviously the various categories of exemption don't apply across the board. Someone who is exempt for purposes of 6049 and not subject to withholding or reporting on interest may still be subject to reporting under 6045 for gross proceeds. And so we think it's up to you, but there may be a benefit to reporting that specific code if you're paying multiple types of income, because it isn't going to be as simple as exempt or not. They may be exempt for some income and not others. I think we've covered the basics of the major changes that we've seen thus far. Moving on to coding changes, and I think we addressed this on the W-9, whether you're going to need those exempt pay classifications. Again, I think the way I look at it is thus far it seems to be optional. There doesn't seem to be a point for FATCA purposes to do all the specific codes for why they're exempt. There may be a reason to do this for Chapter 61 purposes. With respect to your Forms W-8, you're obviously going to need the new fields for the FATCA statuses. You're going to need a field for the GIN, and you're going to have to go and have some indication that when they're filling in a GIN, that this GIN is verified on an annual basis. You're going to need to capture the foreign TIN and the date of birth. We expect those to be two different fields, so you are creating two separate fields for these. You're also going to have to create a series of fields for that branch or disregarded entity of a foreign financial institution that's receiving the payment when that branch is not the same location as the headquarters. And so that'll be a series of codes because you're going to need to know the country that branch is located on, probably the address, the GIN for that particular branch, and any other information that's included in that part. So that could be a series of new codes to enter in there. You'll also need to record information with respect to passive NFFEs and owner-documented FFIs. This is probably something your systems already accommodate because when you deal with the W-8 IMY, you already have the withholding statement where it identifies the allocation with respect to the various owners. So you could probably leverage something like that to report with respect to your owners of your NFFEs and owner-documented FFIs. And these new withholding statements are going to have to be modified to include your Chapter 4 statuses. It probably won't be too complicated. You really just need to add into your existing withholding statements the Chapter 4 information, which for the most part should just be Chapter 4 status, and maybe you'd want a GIN in there. Broader changes that'll be affecting all of the forms, you're going to need to find a way to track changes in circumstances. If you're a U.S. withholding agent, you should already have some method of doing this because this is a current requirement. But if you haven't been doing that, or if you're a foreign financial institution and haven't had to do this before, you're going to need to track, for example, when U.S. indicia is added to an account, or when you receive information that indicates that this entity is not the type of entity it claims to be. You're going to want to identify whether this entity is eligible for indefinite validity. Now, we've heard some institutions say that they don't want to track this information and it's just easier to send your recert out every 3 years. You can definitely do that. But at the same time, by adding that field, since you have to track the change of circumstances anyways, if you can hold yourself off from having to, redocument 40% of your accounts, it may be to your benefit. And then also, all of the costs of revalidating those forms and going out to people and dealing with it, it could save you a substantial amount of money by indicating that 40% of my forms don't need to be renewed because they're valid indefinitely. But if you do that, you're going to want to build a field so that you can identify that, and so you're making sure that you track whether there are specific changes in circumstance that will bust that indefinite validity. The final thing is if you're using the consolidated obligation approach, either to treat multiple accounts as pre-existing even though they were created after the start date of FATCA, or to share documentation across various accounts, you're going to need to track whether that's occurring so that you make sure that the reason to know on one account is being shared with the other accounts. There are obviously going to be more changes involved in this, but those are the high points of what must be changed in your coding for customer onboarding. And we also received questions regarding the alternatives to the W-8 series. What can you do if you don't want to use the W-8? We've already talked about the changes you can use with respect to individuals. You can use a substitute W-8, but you can also use that non-IRS form W-8. With respect to individuals offshore, there's other solutions. You've always been permitted to use documentary evidence for Chapter 3 purposes. And there's also this new, under certain circumstances, you're allowed to use these third-party credit reports. With respect to entities, it gets a little more complicated. There are options provided in the regs and in the IGAs, and the biggest example of this is documentary evidence. Technically, it's in the regs. Technically, it's in the IGAs. But what most firms are advising people is attempting to rely solely on documentary evidence is going to be tough. You're going to have to meet all of the elements that's required, and this is actually more difficult under the IGAs than it is in the regulations. The reason for this is the regulations are very specific. And so when we're talking about an entity like an active NFFE, the regulations actually went into detail and said, look, you don't have to prove every element of the test. What you have to prove is that this entity is foreign, that they're engaged in an active trade or business, and that they're not a financial institution. And that's a substantial reduction in the standard because what they're not making you do is identify that this entity has less than 50% of its assets being passive and that less than 50% of its income is passive, because that test would be almost impossible to do unless you have their financial records, and even then it becomes very difficult to sort through this and make those determinations. The IGAs don't have that level of specificity. They only indicate that you must reasonably determine that this entity is in this classification. That makes it a lot harder because they're not actually lowering the standard. You have to make a reasonable assertion that this entity is an active NFFE. And how do you do that when you don't have their financial records to indicate whether they're meeting that passive income or assets test? And even under the regulations, you're taking on a risk by using documentary evidence because what you're doing is basically, instead of going to your customer and saying, here, the form, just tell me what you are, and I can rely on that unless I have reason to know, you're taking on all of the risk and the legwork of sorting through your documentation. And if you make a determination that isn't reasonable, that risk is on you. And, the issue is, why would you want to take on that risk when you can avoid it? Yes, there is absolutely a customer service issue of going back out to your back out to your customers and getting more information. But especially with respect to new accounts, if they're being onboarded in the first place, that's the ideal time to do this. And the point is you're not alone in this. All of the institutions within your country will be doing one thing or another. Either they're under an IGA or they'll be signing FFI agreements. It's not like you're going to be the only institution out there doing this. And so what we're recommending is it's just a lot safer to rely on self-certifications. And so as to the types of self-certifications, obviously the W-8 BEN is an option, and a substitute BEN, once that final form is out, is a good option. We've also received questions about the written statements and the other permitted self-certifications that are mentioned in the IGAs. A written statement is basically you're kind of taking what is in the W-8 BEN on the official version and removing some of the U.S. indicators. So it doesn't have to be an official W-8. They don't have to be signing a U.S. tax form under penalties of perjury, but they're taking the elements of what's relevant in the W-8 and having their customers, kind of sort through that. The written statement allows you flexibility, so if you think some of the exempt categories don't apply to your industry, you can take those out. It allows you to sort of tailor what's in the W-8 BEN official version to your industry. As to the other permitted self-certifications that are addressed in the IGAs, we haven't heard any more information about those. But practically speaking, they can't get much easier. I mean, when we talk about a form W-8 BEN that's 7 or 8 pages, that sounds really complicated. But the complication is not in the form itself. The complication is in all of the categories and all of the specific requirements that someone would have to meet in order to qualify. That's not going to change depending on the form you use. So even if you came up with a form where all it did is identify all of the Chapter 4 statuses, that's not going to help your customer because they're not normally reading the regulations. If they're a foreign financial institution that's registered and they've got a GIN, well, yes, it'll be very easy for them. But they're not the ones who are going to have problems filling out the form. All of your less sophisticated entities, your smaller owner-documented FFIs, your NFFEs, those are the ones that will need the help filling out the form. And if you don't have the details of what's in each classification, they're not going to be able to go to the regs. So it has to exist either on the face of the form or in the instructions. And I think the reason the form W-8 BEN-E was done that way is so that all of the information is provided on the face of the form. They know what they're certifying to when they check that box. And so the answer is whether there'll be these other self-certifications. There might be, but we wouldn't expect them to be any less complicated. And if they are, it just means your instructions are going to have to be that much more complicated to answer your customers' questions. The other options that you have, and I think the electronic systems are actually a really good, effective way of simplifying what's on the face of the W-8 ban. Because you're kind of doing an interview process, if you choose to do that route, you can simplify some of the questions. For example, if someone's not in liquidation or bankruptcy, you don't have to get through all the other elements of the test because you know up front they're not going to qualify. If they weren't created within the past couple of years, they're definitely not going to be a startup entity. And so you don't have to get into all of the elements of the test and give them this 8-page form. You can guide them through some simple questions so that you can weed out most categories and then just show them the certifications for the ones they're going to likely qualify for. And so that's something where you could be creative and work out your own system to make it easier for your clients. But obviously, you'd want to start developing that now based on the draft forms because that might take a while. The final option you have is to purchase forms from third-party data providers. There are several of them out there that are in business of, they're in the business of getting forms for people. They'll do the validation for you. They'll collect all the necessary documentation to cure any errors in the forms. And so it may save you some of the time and the legwork of going back to your clients and trying to cure the forms and trying to explain what's wrong and fielding their questions. You can actually have another third-party entity do this on your behalf. I think that's the end of what we had to discuss today. I'm going to open up I'm going to open us up for questions, and I know we've gotten several.
Yeah. Danielle, we've been collating questions as you've gone through your presentation. And firstly, thanks for what I think has been an excellent and very informative presentation here with some great info that's provided some very interesting questions coming through as well. So, I say, we've collated them. We don't have time to go through all of them, unfortunately. There's too many to cover in the time we have. So, if you have asked a question that we're unable to answer now due to time, then someone can come back to you on that post the webinar. So yeah, don't worry if we don't get around to all of the questions. And I think we also have one final set of poll questions to ask. So they'll be appearing on the right-hand side of your screen shortly. And please do take a couple of moments just to look through those as we look at the questions. So the first question we had coming in, quite specific, but Danielle, one for you here. How do you cure US indicia for a minor when the only document available is a birth certificate? And the question says they believe the regulations require W-8 Ben and documentary evidence that indicates permanent residence or citizenship outside the US. And can you use a birth certificate for ID in that situation?
So how you're going to cure U.S. indicia for a minor will depend on that U.S. indicia because there are levels of U.S. indicia. You know, an address, a place of birth in the U.S., those are a lot harder to cure than using a POA of someone who has a U.S. address. The general response to your question is yes, you should be able to use a birth certificate. I mean, it's going to depend on the various countries, and if you're following an IGA, it's going to depend on what's permitted there. But generally, the regulations permit you to rely on documentation, valid identification issued by a government body, which a birth certificate is, that is typically used for identification purposes. And I would say a birth certificate would qualify as that. And so it'll depend on the type of indicia you're curing. You know, if they've got a place of birth in the U.S., that's going to be harder. And I will point out that sometimes those, even when you're talking about a place of birth in the U.S., there are reasonable explanations that you can also use to help cure that.
Great, thanks. That's a very comprehensive answer there. We also had a number of questions around TINs and foreign TINs. So just to step through a couple of those. Is it mandatory, and I think you may have covered this earlier, but just to be explicit, is it mandatory to provide a foreign TIN, and what happens if your client refuses to tell you what one is?
We are expecting it to be mandatory. Again, the forms aren't finalized yet, and so anything can change, but I definitely would not expect that to change because the government's agreed to exchange information with other countries. They're expecting to do this by TINs.
Okay.
And so it's we expect it to be required, at least with respect to countries we're exchanging information with. I don't know whether the forms are going to get that specific. If they refuse to provide you one, I think you have a problem. It's a mandatory field. The exception that you have is if their country doesn't issue them one. That's when you're allowed to use a date of birth. But I think you might have a problem if you know their country issues a TIN and they're not willing to give you that TIN. I don't think you have the date of birth as an alternative, but we'll have to wait for the instructions to be sure.
We will. I suspect that's going to be your answer to the follow-up question we had. But if you are provided with a foreign TIN, are you expected to validate that TIN number, or do you take it on trust?
I would say until the government tells you how to validate that TIN, then, I mean, unless it's obvious that, their TIN is 12. Yes, I think you might have to question that. But if, they're providing you a TIN for France and you don't know whether France uses 6 digits, 12 digits, whether they use numbers or not, again, the government is going to have to tell you this, in the instructions. And I think the answer is until they make it a requirement, you're taking it on trust that this TIN is valid. And if there's a problem, the government will have to sort this out. Because it would be very hard for them to do this. They're going to have to go through every country, every TIN, and get the specifications and provide that to the industry, which could be done, but I doubt that's going to be a prioritization anytime soon. A priority anytime soon. So I would say until that happens, you're just taking whatever TIN's written on the paper, unless it's ridiculous.
Yeah, I think we agree with that, actually. I mean, I've worked through European taxes for a number of years, and for some countries it's actually impossible to validate a number, because only the governments can do that, it seems. So it'll be a very, very difficult requirement to meet, I think. And the final question related to that, well, back to US TINs, and related to the previous question, is there a requirement to validate a US TIN, if that's provided?
Yes.
Okay.
I mean, if you're filling out a W-9, there are only so many. They actually mark out the number of digits that have to be filled in, and so if they're missing digits or they're going longer than that, you're going to know that you're not getting a proper U.S. TIN. And so, yes, I think there's a requirement, at least in the United States, to validate a U.S. TIN.
Excellent. Thank you. A couple more general question, and probably one that's impossible to answer. Do you expect any further delays to the FATCA deadlines as published?
It's actually a good question that we've been getting a lot. My answer will be that it depends. If Treasury and the IRS get all of their guidance that they need to get out by the end of this year, so everything that we discussed that we say we're expecting to see by the end of this year, if they do that by December 31st, no, I don't think you're seeing any other deadlines, because they will have met their 6-month period, and they'll consider that you have 6 months to get your onboarding and your new forms in gear. And so I would not expect anything. On the other hand, if we're in January and February and there's key pieces of guidance that haven't been issued, then I think they have to do another delay. But I think the fact that they did a 6-month delay indicates they're pretty serious. They didn't just push it back another year, which is, I think, what many in the industry expected. What they're saying is, we're 6 months behind. That's all we're giving you. We're not just going to keep giving out year-long delays with FATCA.
Okay. No, I think that's as good an answer as we can get from that at the moment, perhaps. Yes, it always depends. I think we've got time for maybe 2 more, and I think they kind of relate to the poll questions that we've just seen, actually. The question, I think, was around repapering now using the current forms or waiting for forms to expire and then using the new forms. I think your suggestion there's pros and cons either side. Are there some situations you think it is better to go through a repapering exercise now, was the question, rather than wait for new forms to come out? I think we look at the survey results we had coming through. I think 10% of our survey was looking to go with the existing forms, so just 1 in 10. Nearly 2/3, 68%, were going to wait for the FATCA forms to come through, and the remaining quarter or so were unsure. So for those that are unsure, what do you think the advice there should be?
It depends on your current situation. If you have a problem under Chapter 3 or your domestic reporting where you have not done what you need to do, where you're doing your FATCA diligence and you realize, oh, God, we haven't documented all of these accounts, you definitely don't wait. You have to do it now. You just don't have a choice, because you don't want to be hit with 30% on all of the payments you're making to those account holders. On the other hand, if your Chapter 3 and your Chapter 61 situation is okay, I would wait, because I think you're just going to have to redo this recertification again later. The one exception, again, might be if you really wanted to send your individual accounts out there and there are not substantial changes expected to that form, I might slap a couple additional fields in, run it by someone, an advisor, to make sure that they concur that this looks like a valid form. You could probably do your individual accounts now, but generally I would wait until the final forms are released.
Great. And one final question that came in right towards the end of your presentation. And the question here is, what's the expectation in terms of timing in respect to obtaining forms for new clients? So should they be in place before entering into any transactions with the client, or can they be obtained retrospectively? I guess that might impact the questions you just made as well.
I'm sorry, can you say that one more time?
Yes, I can. So the question was the expectation in terms of timing in respect to obtaining forms for new customers. So should you get the forms before going into any transactions with the client, or can you wait?
That is going to be a business and risk decision you're going to have to make. I think most of our clients, the safer position is to say, look, we're not opening an account until we get a form. To have this requirement that you make sure that everything is documented and in place before you make any payments. Because otherwise you're in a position where now we're making a payment to them and we don't have our forms, and are we going to have to withhold and escrow that withholding for a period while we're getting the form, or are we going to have, potentially be subject to 30% because we failed to withhold? So it's a safer result to get the documentation up front. On the other hand, it depends on your industry. If that's not practical, you may need to come up with measures in terms of what you're going to do, which may just be over withholding initially until you get documentation. And I just wanted, that kind of segues into a couple of questions that seemed sort of on the same track. People have been asking what does it mean to be a withholding agent? A withholding agent is basically someone who has control of a withholdable payment. And so either because you're the party making the payment or because you can direct that payment away from you. And so, for example, you don't get to not be a withholding agent because you tell your agent, oh, you pay the payment instead of me, so I don't have to do anything. You're still a withholding agent. On the other hand, if you never touch the money and you have no control over the money, you would not normally be a withholding agent. And so there will be many introducing brokers who are not withholding agents.
Great. Okay, Danielle, I think unfortunately we're hitting pretty much our time limits for this. So thank you very much for both the presentation and for the tremendous answers here. We have had more questions we haven't been able to get through. So as I say, we'll be able to get back on those as soon as we can, just to give a bit of a fuller answer. So Danielle, thanks again. Thanks everyone for attending, and we hope you enjoyed the session.